Welcome everyone as we will wait 1 minute for everyone to join us here. You know, some folks are still hopping on. Okay. All right. So welcome everyone. I'm Rebecca Monroe with Christian Financial Credit Union. I know we'll probably still have some folks hop on in just a minute, so that's great. I just want to thank you this evening for spending your evening with us. I know everyone is very busy, so we appreciate you taking time out to meet with us and hopefully learn a lot about mortgages and the home buying process this evening. We are here with Mortgage Center, which is our exclusive mortgage partner. We're actually an owner of Mortgage Center, and they've been our exclusive mortgage partner for more than 30 years. So they are our partner with all of our mortgages. They're a great, great partner to us and to our members. This evening, as a special treat, I guess, all of our attendees this evening, if you are here for the entire duration of the webinar this evening, you're going to be entered to win a $250 Home Depot gift card. So make sure to stay on. You must be present to win at the end in order to win, and we'll announce the winner at the end of the evening. One last note, please don't put any sensitive information in the chat or in the Q&A. We respect your privacy, so please don't put your social security number or member number or anything like that in the chat. Just want to make sure we're being concerned for your privacy, obviously, but definitely put any other questions you have related to the home buying process in the chat. We have some folks here that are happy to answer your questions. So without any further ado, I'm going to turn it over and introduce our guests this evening. So we have Carrie and Haas from Mortgage Center. They are our mortgage experts, and they're going to be here to answer your questions and kind of guide us through what the home buying process looks like these days. And we also have Mike from Remax 2000. So he's going to answer some questions and kind of talk about where the market is at these days from a real estate perspective. So we're excited to get started here. So take it away.
Awesome. Thanks, Rebecca. As Rebecca mentioned, my name is Carrie Marintet, and I'm the account executive for Mortgage Center. So I am the one who's going to kind of host this for you this evening. We did get a lot of really great questions at registration, so we did our best to kind of infuse those questions throughout the presentation. Haas is our AVP of Lending. He is going to be running the chat feature tonight. So anything that you have any questions, by all means, throw those in the chat. Everybody's on mute, so nobody can see you. You are muted. You won't be able to take yourself off. That's why we really would love for you to utilize the chat. He is there to answer any, kind of specific questions that you might have. But as Rebecca mentioned, just please don't put any personal details in there because the chats are downloaded and we don't want any of that information to be saved. So tonight, the agenda is going to be, we're going to run through a mortgage checklist. We're going to kind of see if you're ready in the market. We're going to talk about how rates are determined. We're going to talk about why your credit matters regarding a mortgage and what you can do to improve it or fix it. We're going to talk a little bit about payment examples. So I got a lot of questions about how much money do I need for a down payment? How much, do I have to save for closing costs? Those types of things. So we're going to run you through some payment examples and compare some different types of loans so you can kind of make that educated decision. So we are going to go ahead and jump right in. And Rebecca's going to post one of our polling questions. And really, this is just to kind of gauge where the audience is at. So where are you at in the home buying process? Oops. Okay, so it's kind of, you're looking to purchase in the next 30 days, looking to purchase in the next few months, or you're just here to learn a little bit more about the process. All right. So it looks like a lot of us are here to learn a little bit more about the process. We'll give it a few more minutes here, or not minutes, a few more seconds. Sorry about that. All right, so we have a lot of people looking to learn more, and then we've got a couple, looks like they're purchasing in the next few months, which is fantastic because you've come at the right time to kind of do that. Right. So first things first, we are going to talk about our mortgage checklist, and really why this is so important is we want you to be able to ask yourself a couple questions before you start this process. We want you to ask yourself, first of all, do I have good credit? And that's a very subjective question because if you haven't checked your credit, you may not know. So credit score really does play a major factor in getting a mortgage, and we're going to spend a little bit of time on that subject. So essentially, the better your credit score is, the lower interest rate you're going to pay on your mortgage, and that's why it's so important. Number two, how much money do I have as a down payment? So how much money do you have saved? When you enter into a mortgage transaction, your mortgage loan originator is going to ask, how much money do you have put aside for your down payments? How much money do you have, kind of put aside for this transaction? So there are programs out there that are zero down, but there's always going to be some money that you're going to need to bring to the table. So you want to be able to ask yourself, do you have that money saved? Three, payment am I comfortable with on a monthly basis? What is your budget? If you're currently renting an apartment, you know what you're currently paying. Are you looking to stay right around that same cost? Are you looking to spend a little bit more? We love when members come to us and say, you know what, this is my monthly budget. How much house can I afford? Those are always great conversations to have. And then lastly, can you provide verification of income and assets? And what we mean by that is when you enter into a mortgage, we're going to ask you for proof of your income and your assets that you have. So we're going to ask you for W-2s and pay stubs to verify your income. And then if you choose to use certain assets, like maybe 401k or savings accounts, investment accounts, we want you to have access to those documents because you're going to need to supply a copy of those to us. Okay, so how are rates determined? This is a really big factor. I got some questions on that, at registration and how rates are determined. So as you can see right on the top of the page, credit score. That is going to be the biggest determining factor in what you pay on your mortgage. So not everyone is going to qualify for the same interest rate, and your credit score is going to be that driving factor. So again, the higher your credit score is, the lower interest rate you will pay on your mortgage, which will essentially save you money on this transaction. Your property type does play a small role in your rate. And when we talk about property type, is it a single family residence? Is it an investment property? There's different types that can kind of play into your interest rate. Your loan term and your amount. So when we talk about your loan term, if you're willing to take a lower term, maybe a 15-year versus a 30-year, you actually get a lower interest rate because you're not borrowing money for the longer duration of that time. So that does kind of play an amount in there. Sometimes your amount, once you get to a certain amount, could affect your interest rate. Your down payment amount. How much money are you willing to put down on the transaction could ultimately bring your rate down. So someone who puts 0% down versus someone who puts 15 or 20% down, you're going to be seeing a little bit of a rate disparity there. And then lastly is mortgage points. So mortgage points a few years ago really wasn't a talked about thing because interest rates were super low. Mortgage rates have risen a little bit in these last 18 months, so they're starting to become more of a topic. Mortgage points essentially allow you to purchase point, you can buy your rate down. So essentially you're bringing money to the closing table in order to lower your interest rate. So a lot of members opt for mortgage points on their loan because they can essentially buy their rate up front. And if they're going to be staying in the house a long period of time, that will actually break even and you're going to be paying a lower interest rate over the over the 30 years. So a lot of people opt for those options. It's a very personal decision. It's something you should definitely talk over with your loan originator. It's a great option for a lot of people, but it's not for everybody. So we just want to kind of keep that out there. One of the questions that got submitted was, how does CFCU interest rates compare to some of the national lenders? We thought that was a really great question. I wanted to kind of bring up Christian Financial and Mortgage Center together offer some of the lowest rates and costs in the nation compared to other lenders. Mortgage Center does offer a 0 down loan. And there's a lot of options for first-time home buyers. So today's rates, and this is just an estimate, we're at about 6 1/8, which is 6.125. National average is about 6.9. And that was just kind of looking across the board on a 30-year conventional fixed rate mortgage. So as a partner of Christian Financial, we really want to make sure that we're taking care of our credit unions, our partners, their members. So we do make sure that we set our rates very competitive. We check them every day, and we want to make sure that we're under that national average, because we know that a lot of members, especially you guys on the call, you're very rate driven and you are looking for that best rate to get you a low payment. All right, credit matters. So you saw this one come up on the very first slide, and it was one of those very first questions you want to ask yourself is, do I have good credit? The reason we want you to know about your credit score is because it makes such an impact in your mortgage. So essentially, again, the higher credit score you have is going to equal a lower payment. In order to get to that higher credit score, credit scores build over time. So somebody who is just entering into, maybe they just got out of college, they just got their first job, your credit's going to take a little bit longer to build versus somebody who's had established credit. So just kind of keep that in mind. It takes much longer to build your credit than it does to hurt your credit. So you want to make sure you're paying all of your bills on time. Don't ever let anything hit 30 days late, because that's when the credit report will actually be dinged against you. And it will take much longer time to kind of correct it than it will just to keep it in good standing. You want to keep your revolving balances low. So what do we mean when we talk about revolving balances? We're talking about credit cards. Those types of things. So for instance, if you have one credit card and it's $5,000 limit, we don't ever want you to be over $2,500 of that. We want to make sure you're always, 50% or less on those revolving balances. The same thing holds true if you have multiple cards and you have $20,000 as an open line, you want to make sure that you're staying under $10,000. When you think of that, we don't want you to close out a card just because you don't use it, because again, that's going to affect your revolving debt. So if you have multiple credit cards with $20,000 limit, but you only use one card and you have $5,000 on that card, you don't want to just close out those other three, because now all of a sudden you're shrinking your capacity and it looks like you've overspent on those revolving cards. So just kind of keep that in mind. Always stay under that 50% mark. Closing an account doesn't make it go away. So if maybe you opened up a credit card because you went into a store and they were going to give you a really great deal and you forgot that you put a transaction on there, it showed up as a collection account. Just because you close the card does not mean that that negative trade line is going to go away. It will stay on your credit report. And then of course we want you to correct any error on your credit report. Christian Financial can help you do that. They have a way that you can pull your credit score, and you can actually ask anybody in the call center. You can go right on your online banking. You can see those credit scores, or we would always suggest annualcreditreport.com. Those are the types of things that you always want to do. You are entitled to one free credit report from every agency. So there are 3 agencies. There's Experian, TransUnion, and Equifax. You are entitled to one free report from each bureau once a year. So always keep that in your back pocket. It's a really great thing, really great habit to just kind of get in habit. Check those credit reports, especially if you have not checked it in a while. You always want to know where you stand. There could be an error on there. And if you find an error, make sure you get it corrected. Lastly, avoid large purchases leading up to the mortgage transaction, just because those large transactions could essentially change your debt to income ratio. And if you're entering into the mortgage or you're in the mortgage process, we don't want you to change your credit history at that point. And what we mean about that is if you're in the loan process, we don't want you to go to Gardner White and buy a bunch of furniture and put it on a credit card. But even though it's 0%, it's still affecting your ultimate credit picture. We don't want you to do that. If you have to purchase a new car or your lease came due, always talk to your loan officer before you do that, because we don't want to change your credit situation during that transaction. A couple questions that came up that I really wanted to touch on. It said, can I get a mortgage after a bankruptcy in 2017? So just to kind of give you a little bit of background about bankruptcy, Chapter 7 does have a 4-year discharge waiting period. So as long as you're over that 4 years, you may be able to qualify after that, as long as you've reestablished some credit. So we just didn't want you to stop and not do anything. You do have to reestablish credit over that time. We also got a question that said, can you still be approved for an FHA loan with a collection on your credit report if it's over a 580? You can absolutely be approved for a mortgage if you have a collection account. FHA allows you to get approved at a 600 credit score. So we really need you to be over a 600, but sometimes collections happen. It really depends on the type of collection that it is. We see medical collections all the time. Those get reported very, very quickly. So a lot of times, those are very easily explained on those. So it's absolutely possible. All right, so we talked a little bit about how rates were determined. So let's talk a little bit about what affects your payment, because obviously your monthly payment is really what you're looking at. How much can you afford? So first of all, the cost of your home, of course, is going to drive your payment amount. The more you borrow, the higher your payment is going to be. But your percent of down payment is going to also drive your payment. So again, Mortgage Center does offer a 0 down. Most members will put 5% down. That's a very common down payment. A big misconception out there is that you have to put 20% down in order to get a mortgage. That's absolutely not true. Again, most people are going to put 5% down. If you are a first-time home buyer, we do have a 3% down program for you. And that is a fantastic program that's out there. Also FHA, we're going to talk about that one on the next slide. FHA also has a very low down payment. So again, percent of your down payment will affect your ultimate monthly payment. Your interest rate. So again, you've got a really great credit score. You're going to pay a lower amount in your rate, which of course, a lower interest rate will give you a lower payment. Your length of the loan will affect your payment. So again, we mentioned a little bit earlier, if you are going to do a 15-year versus a 30-year loan, your payment will be a little bit different. But please don't think that if you go to a 15-year, your payment is double. It's not double of what it is on a 30-year loan. So there's a lot of cost savings that go into a 15-year mortgage. You typically get a lower interest rate, but your payment's a little bit higher because you're only, taking out that money for 15 years versus 30. So if you're in the position to do it, it's a great option that's out there, but your payment will be a few $100s higher than it would have been with a 30-year. Lastly is your escrow account. So what is an escrow account? What does it do? Do I have to have it? Your escrow account is essentially your taxes and your insurance payments that your mortgage provider will pay for you. So what happens is when you enter into a mortgage, we're going to add on your taxes and your insurance to your payment. And then us, Mortgage Center, as your servicer, we would make your payments twice a year. So typically August and December is when we make summer and winter payments based on the county that you live in. Most members, I would say about probably 98% of members do have an escrow account with us. Most people don't want to budget their taxes on their own. It's a very large bill that comes due. And if you don't put 20% down on a mortgage, which again, most people do not, the mortgage provider is going to add your escrow to these loans. So if you were looking to not have an escrow account, you do have to put a little bit more money down, but really it's a great thing. You don't have to budget for it. It's already going to be included in your monthly payment, and we will pay your taxes and your insurance for you. Another question that we get all the time is about private mortgage insurance. A lot of people just don't understand why it's there. And they kind of want to know, well, do I have to have it? Maybe I heard it doesn't really do anything for me. And I'm here to say it's not going to do anything for the borrower. It's not a protection or an insurance policy that you can cash in on at any time. It's solely in place to protect the lender in the event you default on the loan. So essentially what happens is a mortgage company will say, if you put 20% down on your home, so think about that for a second, $100,000 home, it's $20,000. Most houses are more than $100,000 today. That's an astronomical amount of money for a lot of people to put down. Most people can't come up with that kind of cash. So if you don't put 20% down, you get what's called PMI, private mortgage insurance added to your loan. And it's not an insurance that you can collect on. It's simply there to protect the borrower. It's not something that you can waive. So it is there, it is added to your loan. And again, we'll kind of go over a couple other ways of how you can eliminate it down the road. One of the questions that came in, it just says, if you're close to retirement age and are a first-time home buyer, how do you financially plan for that? And really, it just comes down to you need to have enough money saved for that down payment. And then, of course, make sure you have money for costs and repairs, depending on the type of appraisal you get. There might be some, repairs that are necessary for the home. And then, of course, we always want you to have a few $1,000s in the bank as a reserve. And your loan officer will walk you through that. We never want you to finance the absolute highest because, of course, if you're heading into retirement, your income is going to change and you want to make sure that you can sustain that payment. All righty. FHA versus conventional. These are two very popular loans that are out in the marketplace today. FHA versus conventional, we get a lot of questions about if I'm a first-time home buyer, do I have to go FHA? And the answer is no, you don't. FHA loans are really designed for members who might have had a credit hiccup along the way. Maybe their credit score is not exactly where they want it at this point, but their family's in a situation where they really need to get into a home or a new home, whatever the case may be. So FHA allows you to put a lower down payment amount. It's always 3.5% if you're going to be going FHA. No matter where you go in this country, it's always going to be a lower down payment of 3.5%. And FHA also allows a little bit more leeway when it comes to debt to income ratios. So it's a little bit easier to qualify for those members. So I wanted to share an example with you. And we're going to use a purchase price of $220,000. And this is based on a 30-year loan. So I just want you to kind of look at the differences here. So if we're looking at a $220,000 loan, the down payment is really driven by your program. So FHA, always 3.5%. It's about $7,700 that you're going to put down. And on a conventional, again, most members put 5% down, so 11,000. So you'll see the loan amounts a little bit different there. Your rate is going to be higher with an FHA loan than it's going to be with a conventional. So that's going to be a little bit of a trade-off that you kind of have to decide, do I absolutely need to do FHA or could I do a conventional loan? And again, your loan officer will absolutely present both options for you at this point. So if you take a look there on the screen, I'm just going to focus on the rate there, 7% versus the 6.125. So a little bit different, which of course is going to drive your principal and interest payment. So there's not a huge difference. It's about $170 there for monthly difference. But what starts to affect your payment is also your PMI cost, your private mortgage insurance. So with an FHA, premiums are going to be a little bit higher. It's about $102 a month that's going to be added to your monthly payment for the duration of your loan. So with an FHA, your PMI, private mortgage insurance, is never going to come off of this loan. You are going to pay it for the life of the loan. When it comes to a conventional mortgage, rates are a little bit lower. So you see it's about $52, and you'll see on the screen there it says for approximately 7 years. So if you enter into a conventional loan, as you start paying down your mortgage balance, you're going to get under that 80% mark. And that's kind of the magic number when it comes to when PMI can come off of a loan. So as you pay down your loan, in this case, about 7 years, your mortgage servicer will remove your private mortgage insurance. You no longer have to pay that monthly cost for your loan because you're now under that 80% mark. So that's a really big benefit when it comes to conventional loans. So what if you're the person that says, I'm only able to qualify for an FHA? How do I get rid of this private mortgage insurance? And the answer is, in a few years, you're going to obviously be paying your loan on time. You're going to be building your credit over time. You're going to give us a call back and you're going to say, I'd like to refinance into a conventional loan. That's a great way to drop your private mortgage insurance. And then, of course, also drop your interest rate because you'll be moving out of an FHA loan into a conventional loan. Okay. We did get one question that says, are there any new FHA programs? So FHA did reduce their private mortgage insurance costs, and they're working on some new programs, but nothing is actually in the marketplace yet. So could be coming, but again, nothing has been approved to date. All right. A lot of the questions that got submitted talk about affordability, and members always want to know, how much money do I need to bring to the table, and how much are closing costs going to cost, those types of things. So we really wanted to run you through an affordability example, and it's kind of how much house can you afford? So we use Mark, the member, and Mark's 37. He's looking for a home in Wayne County. His financial snapshot, he makes $60,000 a year. He's got an excellent credit score, and he's got a current monthly debt obligation of about $550. So probably a car and maybe a small credit card is all Mark has. So how much could Mark afford? Well, when we're looking at qualifying somebody for a member, we use a debt to income ratio. And what essentially we do is we're going to look at your gross pay, which is before taxes are taken out. We're going to use that number, and we're going to kind of take out all of your current debts that show up on your credit report. And when we look at those numbers, we want all of your current debts, including your new housing payment, to be under 43% of your gross monthly income. And again, that's before taxes. So if we look at that 43% as the magic number, Mark can afford a monthly payment of $1,600. So we're going to tell Mark he can shop for a home between $160,000 and $175,000. That's going to keep him at that $1,600 mark. So what is Mark going to need to bring to the table? Well, Mark's going to need 5% down. His purchase price, he went with the higher amount, the $175,000. So he needs to have $8,750 as his down payment. And his closing costs, his interest, his taxes are going to be estimated around $6,000, because keep in mind, you're going to be prepaying your taxes up front. That's kind of where that money comes from. So Mark is going to need $14,750 in order to purchase that home of $175,000, I'm sorry. So that kind of gives you an idea of kind of everything that goes into the transaction. All right, so we walked through the affordability example. Mark was trying to figure out how much house he can afford. Well, what are Mark's options? What kind of loans are out there for him? Of course, we have the conventional fixed rate loans. Those are going to be your very standard 10, 15, 20, 30-year loan. And we say fixed rate, meaning you're going to know your interest rate and your payment are fixed for the duration of the loan. They're not going to change. Adjustable rate mortgages are also known as ARMs. Those are going to be the mortgages that actually became very popular in the last year. Those are going to have an adjustable interest rate. These are not balloon loans. These are not interest-only loans that you might remember from 20 years ago. These actually do give you a fixed payment, and then we can kind of adjust. And I do have a couple payment examples to show you. We, of course, will do FHA if maybe you're looking for qualifying. You need a little bit lower credit score to qualify, a little bit less money down. We do those. If there's any veterans on the call, VA loans are always the best option. In those cases, you get some really great benefits with a VA loan. Anybody looking to build, we can do a one-time close construction. We can even roll the cost of your land into that loan, which makes it fantastic. As we talked about in a couple slides, yes, we have a zero down loan. Everyone asks, what's the catch to it? The essential catch is your monthly payment's going to be higher because you didn't put any money down. So that's really the trade-off on those. And then one of our most popular products that's out there is going to be our PMI Saver. So you saw me talk a lot about private mortgage insurance and what happens if you don't put 20% down. You're going to get that private mortgage insurance. We have a loan that if you are able to put 10% down of your purchase price, we're going to waive that mortgage insurance for you. So extremely popular loan option that's out there. Okay. We did get a couple questions that are just asking about, are there any programs for first-time homebuyers? Are there any tax credits? So no, there are no tax credits. Programs for first-time homebuyers, those really depend on where you live. Mortgage Center does not participate in any of those programs. MISTA is an option that's out there, but we always say make sure you're researching those types of programs. There is a lot of stipulations that go along with down payment assistance programs. They usually make you live in the house a certain amount of time. You won't be able to refinance the house, those types of things, or you would have to pay back that cash. So again, if you're looking for those types of options, make sure you research that and find out kind of what those stipulations are so you don't get stuck with a large bill if you look to sell that house. The other question that came in was non-owner occupied property. We absolutely have investment properties. We can absolutely help you finance those. Give us a call. We'll be more than happy to help you. We're also licensed in Florida, so we do a lot of second homes outside of the state of Michigan. All right, so we talked a little bit about what types of loans we can help you get. Let's really dive into the types of adjustable rate mortgages. These again became very popular over the last year. They've been able to save members a lot of money, but they're confusing. A lot of members, you're going to see all these numbers on the page, and what does it all mean? So I want to break that down for you. When you're looking and you're trying to educate yourself, you see all these numbers. So the first group up there is a 3-6, a 5-6, and a 7-6 ARM. All that means is it's going to be fixed for the first number, the 3, the 5, or the 7. And then your loan is going to adjust every 6 months after that. There's also types of loans which Mortgage Center has, a 3-1, a 5-1, and a 7-1. Again, that means we're going to give you a fixed rate loan for 3, 5, or 7 years, and then we're going to adjust your interest rate annually. So if you take a 7-1 ARM, you're going to get a fixed interest rate for the first 7 years, and then on the 8th year, your payment could adjust up or down based on market conditions at that point. So they're actually very, very popular just because you really can get a great deal when it comes to interest rate. So let's walk you through an example, especially if you're really trying to crunch numbers and you're trying to figure out, should I do a conventional? Should I consider an ARM? We always present both options just because sometimes there's some really great savings in there. So let's take a look on a $200,000 loan. We're going to compare a 30-year fixed rate loan and a 7-1 ARM. And the reason I chose a 7-1 is that tends to be the most popular at this point because you're still guaranteeing yourself 7 years at a fixed rate. So if you take a look, the first difference that you're going to notice there is the interest rate. So on a 30-year, you got 6.375 versus your 7-1 at 5.5. So right off the bat, you're going to notice that the ARM loans are going to be far less than what a conventional is. So what does that do to your payment? You can see the payments there on the screen, just over $1,200 and $1,100. And then you have to consider your PMI because again, you didn't put 20% down. So there's going to be private mortgage insurance added. So 30-year fixed does have a better rate. They consider it less risky. So about $73 a month for PMI versus the $110 on the 7-1 ARM. So when you're looking at that, your initial savings over the period is $6,300 with a 7-1 ARM, meaning if that member is paying $1,200 a month for that 30-year fix, they know what they're paying every single time. But with an ARM, you're paying a lower amount. So for those 7 years, you not only are paying less, you're also gaining equity. And that's that other line item there, additional equity. Because you're paying more money down on your principal balance, you now have more equity in your property than somebody who did a 30-year mortgage because they have not paid as much down on that principal balance yet. So your total initial savings by doing a 7-1 ARM on a $200,000 loan is about $8,300. So it's a great option for a lot of people, especially if you don't plan on living in the home very long. Maybe you were only planning on living there 5 to 7 years, or maybe 10 years was your max. That might be a great option for you because you've saved $8,300 over your neighbor who did the 30-year fixed. So what happens when the rates adjust? So you can see there, we have a maximum rate and we show you a 225 cap, more numbers. So what we want to kind of educate you on there is what does that first 2 mean? So your first 2, the 225 is your initial rate change, which essentially means your interest rate on your 8 could change up or down by no more than 2%. So if you got that loan at 5.5, it cannot go higher than 7.5 in that first year. On the second two of the 225, those are your subsequent rate changes, meaning on year 9, 10, 13, 16, anywhere down the road, a subsequent rate change can never exceed a 2% change. And again, it's up or down. If the market is down, ARM loans are fantastic. Your rate and your payment will actually go down. The 5 in the 225 number is your lifetime cap. So when we talk about that, your lifetime cap on a 7/1 ARM is no more than 5%. So your max rate on this 7/1 ARM loan at any given time is 10.5%. So just keep in mind, you're not going to get that subsequent change. You're not going to get a 5% change in the first year. It is very gradual, but that is the lifetime cap. And you really want to pay attention to those numbers because there's a lot of programs out there that will change your interest rate every 6 months. Mortgage Center doesn't feel that that's in the best interest of a member, and we choose the program that would only change your rate annually. And again, a 5% lifetime cap we feel is more beneficial than maybe some of the other programs that you've seen out there. So again, your maximum principal and interest payment would be about $1,600. So that's definitely a change from the $1,100 that you initially paid. But again, you might have already sold the house. You might be refinancing at that point. So yes, there's definitely a difference when it comes to ARMs, but the initial savings up front is fantastic. And a lot of members kind of take that in. One of the questions I wanted to bring up was, how does the home buying process look with today's current economic climate? For example, increasing interest rates on homes. This is a question that everybody asks. So I just wanted to point out, last year I did this slide and rates looked very different. So last year, rates were about 5.1%. ARM rates were in the 3s. So it was a very different kind of rate environment. But please know there's never a bad time to buy. Even if market values go down, they're always going to rebound. So the history of interest rates always kind of show that when the interest rates go up, the home prices are going to come down. So don't get scared by that. Even if you enter into a mortgage while interest rates are in the 6%, just know in a couple years, you'll be able to refinance and that rate will come down. So historically, they've always done the same thing. All right, let's talk a little bit about the process. What do you have to do? That's why you're all here tonight. How do I get a mortgage? First steps first, we want you to get pre-approved. A lot of people think they need to just apply for a mortgage as the first step, and that's actually not the case. So about 90 days, 60 to 90 days before you're actually ready to purchase, we want you to give us a call or go online. And we want you to get pre-approved. And what we want you to be able to do at that point is provide your income and assets to us. We'll run some numbers. We'll send you a letter, email it, whatever that you prefer. And that's the letter that you can give to your realtor. So if Mike's going to be helping you look for a house, he is looking for that pre-approval letter. Realtors are not going to take you into homes and do showings because they can't put an offer on a house that they don't know that you can secure funding for. So very, very important, make sure you get that pre-approval. Step 2, once you find a house and your realtor helps you put in an offer, you're going to get that signed purchase agreement. Then you're going to come to us and complete your application. So at that point, we'll ask for a little bit more documentation, want to make sure that all of the income is, in place, any assets that you're going to use for the transaction are in place. And then we're going to schedule a home appraisal. So we want to send an independent third-party agent out to the home that you're going to buy, and they're going to do a market analysis on the home. And they're going to tell us, the mortgage company, this house is worth X amount of dollars, and they're basing it on homes that are in a very close proximity to the home you're going to buy. So I just kind of wanted to pause right there because typically the question that comes up is, what happens if my house doesn't appraise for the value that I'm going to buy it for? So there's 2 ways you can go about that. First, you go back to your realtor and say, what can we do? So at that point, maybe your realtors can negotiate and they can lower the price for you. If the sellers are adamant and they say absolutely not, this is the price of the home, it's $200,000, and you only got approved for the 180, you can still bring cash to the table, but mortgage companies are only going to base your mortgage on the appraised value of the home. So it's not that the deal is done. You would just have to supplement your own cash in order to buy that home. So the good news is, you know, like I said, most members are able to work with their real estate agents and bring down the price if it's kind of out of whack. If you guys remember, about 2 years ago, members were paying well over asking prices for houses. So the good news is that has calmed down a little bit. You don't have to be in that kind of bidding war anymore. So once that appraisal comes in, everything's been accepted. We're going to send your file to our underwriter, and they're kind of the last stop. They're going to make sure all the T's are crossed, I's are dotted, everything is in order. They're going to contact the title agents. They're going to make sure that nobody else has any claim to this home or property before you buy it. So they're kind of the last safety check to make sure everything is good. And then we're going to schedule your closing. Closings can take place at a number of locations. They can take place at the title agent. They could take place at the actual house you're going to buy. Some of them take place at the credit union. So that's really up to the seller at that point where they want that to take place. All right, some important documents that you're going to see through this process is number one, the loan estimate. And the loan estimate, we like to say, is the know before you owe. So if you are in the market and you're shopping different mortgage companies, by all means, absolutely shop around. You will find that Mortgage Center will offer you most likely the best value. Again, we want to make sure we're keeping our rates very competitive to what's out there. And then of course, our fees are far lower than a lot of competitors because we don't have the advertising overhead that a lot of those companies do. So with the loan estimate, the great thing about this document, which I'll show you on the next page, they all look the same. No matter where you shop for a mortgage in this country, you're going to see the same document. And that's done very purposefully so you can compare the numbers of all of the lenders. This is going to be provided to you 3 days after your application. We're going to show you your estimated interest rate, your estimated monthly payment, and your estimated closing costs. But keep in mind, your loan is not yet approved, so these numbers are not final. The closing disclosure is the document you're going to get 3 days before closing. And the reason we do that is so if you needed to take that document to an attorney or just have time to kind of talk it over and make sure that everything's in order, we want to make sure you have time to do that before you enter into that transaction. Your closing disclosure is your final terms and costs of the loan. It's your final interest rate, it is your monthly payment, and it is how much money you're going to need to bring to closing. So as a quick example, what is the loan estimate look like? This is the document that, again, everyone will get. It's very, very clear. It will tell you the type of loan that you're entering into. It will tell you if it's a refinance or a purchase. It will tell you the loan amount, your percentage, and your monthly payment. The reason that you see on the interest rate, yes, it says, can this amount increase after closing? This is an adjustable rate 7/1 mortgage. It is very clear to the borrower, yes, this interest rate can change. If you're doing a conventional loan, it will say no, and there won't be any information in that box. For the monthly payment and interest, can this amount change? Yes, it can, or no, it cannot. So it's very, very clear on that transaction. So we always want to make sure that we kind of point that out. One of the questions that we did get submitted, just want to bounce back real quick, was my boyfriend and I are looking to buy a house soon. Since we're not married, how do we go about signing together? You can absolutely sign together. Not everybody that enters into a mortgage is married. But keep in mind, once your name is on the mortgage, the only way off is to refinance. And if you refinance, you have to qualify for this mortgage without that other person. So we always just like to say a mortgage is as big of a deal as a marriage because you can't just take this person off the loan. So just always keep that in mind. Once you're on that mortgage, you would have to refinance and qualify to get the other person off. All right, so Mike, I'm going to turn it over to you for a few minutes to talk a little bit about what's going on in today's market.
Thanks, Carrie. God, you educated me again. You're pretty thorough. Thank you. So hello, everyone. Mike Ayub. I'm with Remax Real Estate. We work throughout Southeastern Michigan. You guys see our billboards everywhere. I service Southeastern Michigan and the western part of the state, also licensed in California and Florida. The real estate market is hot. I'm sure you guys keep hearing that and, keep reading about it and seeing it. As Carrie mentioned, a couple of years ago, it was pretty bad with the, over asking and, homes going for, 20-30% over asking price. Luckily, that's come down. We're seeing it a little bit in some spots, but overall, that's come down. So with, spring and summer, right around the corner, we're starting to see more inventory. Thank God, because that's what we need. Most buyers, the biggest issue hasn't been interest rates, it's, inventory. There just haven't been no homes for sale. So luckily we are starting to see a lot more homes come on the market. My team has an average of a little over 8 years per agent. I've been doing this for 24 years. My advice to you guys that are just, Carrie talked about checklists. If you're going to start looking for a home, you need to do the first conversation I have with anybody who wants to buy a home is, what is your checklist? What is your criteria? What are your must-haves? Do you need X amount of bedrooms? Do you need a basement? Do you need a garage? You need to think this through. You need to come up with your must-have list. You need to come up with, I want, but I can get by with or without it. So, myself or whatever realtor you work with, that's a very important first conversation that you do need to have. First-time home buyers, I'm going to give you a piece of advice. I think you need to be a little bit flexible with what you want. If this is not your forever home, if this is not the dream home, with low inventory out there, in order to have a what we'll call it a bigger crop of homes or, more selection, be a little bit flexible. Be flexible with area if you can, right? If you're not, if it's your first home, if look at neighboring cities, if you're tied into a specific neighborhood that you want to be in, fine. If we can find you something there, that's great. But be a little bit flexible, a little bit open-minded of maybe I can jump over to the next town. I'm going to be in this first home for, 3 years, 5 years, 7 years, maybe that second home or for my ever home. That's when you want to get a little bit more specific. Also, when with a hot market like this, we're going to get into minimizing contingencies and, contingent offers and what they all are, that I think, as you sit with myself, my team, or whatever realtor you're working with, those are things that you really need to go over in a market like this. But I want to reiterate one thing, and then I'll turn it back over to you guys. Carrie said something earlier that is the most important thing. You need to get pre-approved. Do not, if a real estate agent is going to show you homes without you being pre-approved, you shouldn't work with them. Get pre-approved. You can't go shopping at a mall if you have no idea how much money you have in your purse or in your wallet, right? You don't know what stores you're going to go to. You don't know what you can buy. Get pre-approved before anything else, and then we'll take it from there. All right.
All right, Rebecca's back up.
Hi, that was great. Thank you so much. Thanks, Mike. Thanks, Carrie. Thanks, Haas. All right, so I promised that we were going to give away a $250 Home Depot gift card to one of our attendees this evening. So I have good news for Rochelle Lang. Thank you so much for attending tonight. You are our lucky winner. So I'm going to be sending you an e-gift card from Home Depot this evening. So I just want to thank all of our panelists this evening. Thank you, Haas. Thank you, Carrie. Thank you, Mike, for your time. Thank all of our members who joined us and all the folks that joined us this evening. I had one quick thing to mention, actually two really quick things before we end this evening. If you are Carrie mentioned this earlier, through our online banking, digital banking, mobile banking solution, you do get access to your credit score for free. So it's a tool called Credit Coach. You can get your credit score, your full credit report. You can file a dispute. There's a lot of really great tools in there. I'm going to put a link in the chat if you want to check that out. Definitely feel free to check that out. It's called Credit Coach. Also, if you've listened to the presentation tonight and you feel like, wow, I feel really overwhelmed. I want to get a budget together. I want to look at my credit. Maybe I know I'm not in a good place. Maybe I looked at my credit score and I have some work to do. That's okay. We've all been there. We also have a partnership with a company called GreenPath. So our members have free access to GreenPath, and they have a home buyer course that you can take as well. It's a 101 type course for home buyers. If you're like, well, I listened to everything, I think I have some work to do. That's totally fine. We've all been there. I'm going to put that link in the chat as well. That's for our GreenPath Learning Lab online course for housing. But that is all that I had, and I want to thank everyone again for joining us this evening, and have a great, wonderful evening. Bye, everyone.
Bye.